helping you to weather good and bad economies without putting retirement on hold. This is the Tumolo Financial Podcast with Ken and Nick Tumolo. Ken and his son Nick know that creating a comprehensive financial plan can align your hard-earned life savings with your retirement goals. Consider them your retirement architects. Now, the Tumolo Financial Podcast with Ken and Nick Tumolo.
All right, guys, I want to ask you about a column that was posted on marketwatch.com about a gentleman who's doing the things that so many of us are constantly doing. We're trying to do the right things. We're trying to get ahead. We're trying to be proactive. We can't seem to get ourselves ahead. So this 65-year-old guy, he wrote in saying that he's been pulling out about 10% of his IRA, doing Roth conversions. I think about 10% a year was the detail there. But the market, because it's been doing so well, it has been up over 20%. So what's happening is his balance keeps going up. And I think that if we're being honest with ourselves and this guy, this is a great problem for somebody to have. However, a problem still that he wants to fix because he's trying to get all of his money de-taxed. And he feels like he's on a treadmill. He's on a hamster wheel. He just can't get ahead. So what would you say to him or somebody in this position?
Yeah, no, it is a big issue because, I mean, you look at the last 5 years in the market's been up 12+% for the last 5 years.
Right.
And I think it's even 15 or higher. So you look at these things and you say, oh yeah, I need to pull 10% a year out of my IRA to get ahead, and you're still not getting ahead. You're adding to your account balance now. It's really a math problem at the end of the day. That's where I always look at it. That's why we stress the planning on this show.
Yeah.
Because you got to look at other factors too. You got to make sure the advantage is to you and your family. Because usually when people are doing Roth conversions, it's not just for you. It's for the legacy planning down the road to help with taxes with that. So just to give an example too. So this 65-year-old, if he's doing a 10% IRA withdrawal, and let's say he has $2 million, that's $200,000 of Roth conversion. That looks like income. He probably has other income as well, where it could be Social Security, pensions, capital gains. And when that happens, it doesn't just affect your taxes and raise your taxes because $2 million, like I said, $200,000 looks like income. It also could affect your Medicare. So you got to look at every factor. You got to look at IRMA. You got to look at taxes, and you got to see if it gives you the advantage. So sometimes it just shows that it makes sense to do the Roth conversion in that example. Maybe that guy makes sense to do it at 100 or 120,000 rather than doing the 10%. This is why I don't like to just go blanket a number. Everything's just not black and white when you're looking at these things. There's usually a lot of gray with this.
Yeah.
You want to make sure that it works for you. So like when I do Roth conversions with my clients, I'm looking at what their best advantage is. So to give an example, I actually have a client right now that I just did one for, and she has about, I think it was 2.4 or 2.5 million in her IRA. And like you said, the market right now is around 15%, depending on when this episode comes out. So 15% of 2.5 million, I'm not even doing that much of a Roth conversion, just because it doesn't make sense for her. She's single as well, so the tax code's more unfavorable than a couple. So there's a lot of factors, and we ended up doing like a $70,000 Roth conversion rather than doing a 10% or even 15 to just take off everything above the principal too, or the gains. So you're doing what's best for the client at that particular point.
Right.
What's the best advantage for them, and what's to come too, because her big thing is legacy planning, because she knows she's not going to spend all that $2.5 million. We got to worry about her 3 kids. How's that getting divvied up with the new beneficiary rules too? You want to start looking at doing those Roth conversions. Does it make sense to be a more aggressive? Like for her, she's a state worker. They reimburse her for Medicare. So like IRMA's not an issue for me when I do Roth conversions with her. So there's a lot of different factors for people. That's why I say every case is different. Every person is different. Someone that might, like I said, someone down the street, Joe, might be able to do a Roth conversion of 30,000. Sue down the street might be able to do it for 120,000. It just depends on the situation, depends on what you're looking to do too, what's your end goal. Because if the Roth conversion is just for you rather than legacy planning, sometimes it shows that maybe it might not make sense to do it, or it does. So that's why I say, talk to someone, talk to a financial advisor, retirement planner.
Yeah.
We do this complimentary, our Tumolo retirement checkup. So our phone number is 860-854-3434. or you can go to our website at tfcheckup.com.
Yeah, and Nick, I had someone you'll probably think of the person because we just did all our Roth conversion stuff for clients. It's September, October, November, and early December is always busy for us because we're doing conversion stuff. It's a lot of the tax planning. You think about it, an accountant is busy from January to, I'm going to say about May. They're pulling their hair out. Our busy time, end of the year when we start to do tax planning, it's that last quarter of the year. It gets a little crazy here, but we have fun doing it. So thing is, we just actually had a case just like this. And we've got a few of these with the market doing so well. We're doing these conversions. And if you projected it with a lower rate of return when you're doing these conversions, then a lot of times the conversions get ahead and can actually empty out an IRA. And a person gets ahead that way. But for like that question that you asked, Heather, about the guy that's been pulling money out of his IRA, but his IRA keeps going up and it's just not going in the right direction.
Yeah.
The thing is, think about this. If he wasn't doing that, then all that money that he pulled out would still be in there and he'd have a huge tax issue. Right. So what he's doing is he's getting ahead of it on some of the money. And it's a good problem to have. That Roth money passes on to beneficiaries tax-free. So there's a lot of reasons to do it. But the biggest reason when we're looking at it is if the client or the person we're talking to, the listener, doesn't gain a big advantage doing it, then does it benefit the kids down the road, the beneficiaries?
Okay.
If it does, then the plus for the person doing it, even though it's not benefiting them today, is that they're leaving more to loved ones, less to the IRS. Okay, so that's a big thing. You want to leave more money to the people you want to leave money to. Not just like let it pile up and then it all goes to the IRS and the state of Connecticut, the state of Rhode Island. I mean, it's keep what you can in your family, help your family. Of course. I hate to say that, but that's what it's about.
Well, if you're not helping yourself and your family, you're going to be helping Uncle Sam. So which would you prefer?
Exactly. And we know how they spend. So the thing about it is these conversions do help. But when you're doing them, you don't want to just like arbitrarily pick a number. We had a case come in and it was actually a listener that came into East Berlin and he's telling me, I convert $100,000 every year. And I'm like, okay, who gave you that math? And, the whole thing was, he was actually helping himself and his wife. But they were actually doing a little bit too much. They were pushing a certain chunk out into a higher tax bracket. And mathematically, based on what they had saved in the IRA, what we did was we rebuilt out a projection for them and showed them that if you actually converted only, and it was roughly about 73,000. I know that's kind of crazy how you knock off $27,000. But the thing is, it still worked out mathematically where they'd empty out the IRA, get it all over to Roth, and then go to the kids. The big difference, they paid roughly about $9,500 less in taxes if they do it that way.
Okay.
So I mean, almost $10,000. Those things add up. So now they're keeping an extra $10,000 in their pocket. And on top of it, we know we're in a low tax rate environment right now. But we also know that the country has all kinds of expenses that they're not keeping up with. So we think that what's going to happen in the future is one of these presidents is going to have to give in to raising taxes. It's just going to happen. It's hard to take away things that you give to people and because they plan around them. It's so... Yeah, I know Nick mentioned earlier the whole medical piece and people plan around Access Health in Connecticut. So they're planning their spending, planning their income around that. And what they do, the thing is taxes most likely will go up. And those things that people plan around probably won't go away. So we'll always have those expenses that the country has to make up for. So by doing these conversions, one other positive to it, and this is kind of a little bit more alongside it, and with planning, we always look down the road. Think about it. If they raise taxes 5, 6, 7 years from now, you've already converted your money at the lower tax rate. So, which is huge. So, and we can't figure that number in. We don't know what that number is going to be. But we know that taxes will most likely go up. So you want to get ahead of the Roth conversion. On top of it, ahead of the taxes, I should say, and do the conversions. But one more thing I want to add, because I don't want everyone to run out and do a conversion. It doesn't work for everyone. I had a guy in here. His goal was to get all the money to his son tax free.
Okay.
But him and his wife both had big pensions. And when he did the math on it, husband and wife, their tax bracket was over 30%. Their son's tax bracket, not as good of a job, was about 12 to 15% on average.
Okay.
So that's roughly 15% less in taxes. So in that situation, if the goal is to move the money to the child down the road, the best thing that they could do is not do the conversion. And then later on, their son would do basically conversions when he inherits the money.
Interesting.
Yep. Or what he would do is draw money out to cover his expenses.
Okay.
And that's their only goal. One kid. So it made the math easy.
Okay.
So for them, don't do a conversion. So when we talk to people, it comes down to the amount of the conversion, also the income sources, their spending, and then we roughly figure out from there what the taxes are going to look like. We actually use some software for that. But the thing is it's emulating a tax return so that we could say, okay, by the way, if you convert this amount, this gives you the best advantage.
Let me add one more thing to your list there of what it comes down to for people. It's also your end goal. To this point of this couple, their end goal was to leave the money to their son. And that's in this case scenario, and for everybody's case scenario, is a huge factor. It's like, okay, so what's the end goal? You have to kind of almost work your way backwards, like a Tarantino movie. Start with the end and then go back from there. Yeah.
So we start with always that Tumolo Financial Retirement Checkup. We do it complimentary for listeners. Our number, 860-854-3434. Or you go right to our website, tfcheckup.com, and book an appointment right there to meet with us.
Investment advice offered through Tumolo Wealth Management, a Connecticut-registered investment advisor. Content contained herein should not be construed as an offer or solicitation for investment advice or for the purchase or sale of any security, insurance, or other investment product. Please consult with a qualified financial, tax, accounting, or legal professional before implementing any ideas or strategies discussed here.